Hey everyone, Adam Bergman, tax attorney, founder of IRA Financial. Today, we're gonna have some fun talking about real estate investing with your retirement funds. So just wanted to thank everyone who has joined me on Ask Adam over the last several months and all the new people that are joining today. Thank you. Welcome to the family. Welcome to the Self-Directed Retirement Nation. Today, want to do a little bit of an alternative angle on this Ask Adam. I actually prepared a presentation, a short PowerPoint presentation that I thought would help drive the discussion further. So what I'm suggesting is I'll go through this presentation, which will go through the basics of how you can use your retirement funds to buy real estate. We'll talk about prohibited transactions, talk about unrelated business taxable income rules, talk about commingling personal and retirement funds, even look at some case law. And what I thought is that people can ask questions to help supplement what I'm talking about. So I will kind of go with this platform model as long as I think it makes sense. If I feel like questions are all over the place, I'll kind of get through the presentation quicker than usual and kind of just go right to the question. So let me get started. First question, are you still planning to start a private mortgage loan fund? I'm actually working with my attorneys on that to make sure that it's something legally we can do because there's some issues we're working out. Because at the end of the day, what's most important to me is have no conflict of interest with my clients. So before I set up a fund and put clients in a fund, I want to make sure that from my perspective, as someone who takes ethical responsibility seriously, I'm not at any potential conflict of interest. So thank you, Avon, for your kind words. Here's my bio. Obviously, you guys know who I am. I founded IRA Financial. I'm a former tax attorney. Written 8 books on self-directed retirement plans. This is my love of my life. This is my passion. This is what I am super focused on, and helping educate people about the power of the U.S. retirement system, the power of deferral, compounded interest, and of course, the ability to use your retirement funds to make alternative asset investments. So this is something that is super important to me, and something that I hope to share with all of you. So let's get started. As you know, basic retirement plans, you have IRAs, Roth IRAs, SEP IRAs, simple IRAs, and solo 401k plans. Those are the basic type of retirement plans that you can use to make real estate investments. So, IRA by the numbers, and it does look a little bit backwards on the screen. So, my apologies about that. I will make this presentation available for all of you. But what I'm thinking of actually is just kind of going through real quick that there's 53 million IRAs out there, $32 trillion retirement funds. However, less than 5% are invested in alternative assets. So the most important thing is education. People just don't know you can use your retirement funds to buy alternative assets like real estate. And that is, probably my biggest passion and my biggest focus is to help and educate people in this area. So the traditional IRA is the most common type of IRA. It's a pre-tax IRA. The rules are pretty simple: $6,000, $7,000 contribution max in 2021. It's tax deductible, so you get a deduction. Once you're over 59.5, you can pull the money out without penalty, just tax. Once you're over 72, you have to take what's called require minimum distributions, which is generally 3% of your IRA value. When you pass, the funds will go to a spouse or a non-spouse, which will have the ability to take the funds out over 10 years. If you pull the funds out before the age of 59.5, you'll pay tax and a 10% penalty. The Roth IRA is kind of the opposite of the traditional IRA. It's an after-tax IRA created in 1997. No tax deduction, so long as you're over 59.5. Roth's been open at least 5 years. All your distributions are tax-free. No required minimum distributions at 72. If you take the money out prematurely, prior to the age of 59.5, you are going to pay tax and a 10% penalty on all the appreciation on your Roth contributions. Contributions are never subject to tax, and you can pull them out at any time. A SEP IRA is a profit sharing plan. You can generally put away 20 or 25% of your comp if you're a W-2, up to 58,000 max in 2021. There's something called the 3 and 5 rule, where you only have to offer benefits to your employees who have worked for you 3 of the last 5 years. So that's kind of an angle some people use to set up a SEP without having to offer benefits or retirement accounts. Simple IRA is kind of a poor man's 401k, lesser contribution options, $13,500 in 2021, has to be pre-tax. There's also a catch-up of $3,000 if you're over the age of 50. And it's quite a popular plan, but not nearly as popular as the SEP or the 401k. Why? Because the 401k you can put away $19,500 or $26,000. The only advantage of the simple, I would say, is that there's no IRS Form 5500, so the admin's a bit easier, but you're putting away less money. That's the one thing I would say. So questions are starting to roll in. Feel free to send me or submit your questions. And I'll kind of get to them as I go through this presentation. The Solo K, again, it's my favorite retirement plan for the self-employed. You can put away 58 or 64,000 if you're over 50. There's 2 components. There's the employee deferral and the employer profit sharing. Employee deferral lets you put away 19,500, 26,000 if you're over 50, pre-tax or Roth. And the employer profit sharing lets you put away 20 or 25%, kind of like the SEP, up to a maximum of 58 or 64.5. There's a loan feature, lets you borrow 50,000 or 50% of your account value, whatever's less. Use that for any purpose. 5-year loan, whereas a SEP has no loan feature. And of course, you can do traditional as well as alternative asset investments. Not all solo Ks are the same. If you go to a bank or financial institution, they're not going to let you buy real estate or Bitcoin with your 401k. Our plan does. So, that's something to keep in mind. In order to be eligible, you need to have a business with no full-time employees other than yourself, another owner, or spouses of owners. So you can't have anyone that's not an owner or a spouse that works more than 1,000 hours in the year to be eligible for a Solo K. So the Solo K is a secret weapon for real estate investors because it has an exemption of the UBTI tax. So I'll get to the UBTI tax, the unrelated business taxable income tax, shortly. But if you use leverage, if you are a lover of leverage, which what real estate investor is not, you can use a solo 401k with leverage, non-recourse loan, and not pay any of this UBIT tax, where you would be subject to it in the case of an IRA. Let me get to some of these questions, see where we're at. Are you available to see new potential clients? Yeah, obviously, that's my passion. I want new clients. I want to help educate you guys and let you know the secrets of the self-directed retirement plan. So yeah, you can hit me up at A. Bergman at IRA Financial or info@irafinancial.com. I'd love to help you out. Borrowing money for real estate investing in a solo Roth. If you need 200K to do a property investment, only have 100, what borrowing must be avoided and what borrowing is allowed? So perfect. This is a great question. Solo 401k, as I mentioned, there's an exemption to the UBTI tax. So using leverage is super, super valuable in a 401k plan. The way to do it, number one, is be a non-recourse loan. So it's a loan you do not personally guarantee. And number two, you need to obviously do your diligence and make sure that the investment makes sense. Generally, most non-recourse lenders will require at least 35% down. So if the property is 200 and you want to put 100 down, I can get you a non-recourse loan. The property income from the property will help pay off the loan. And since there is no UBTI tax like there would be on an IRA, you basically are using leverage tax-free, penalty-free in a 401k. And if you do it in a Roth, then so long as you wait till you're 59 and a half, the Roth has been open at least 5 years, bang, you'll be able to pull the money out my tax-free, penalty-free. So it's a great, great investment strategy for real estate investors. I have so many clients trying to get into the Solo K. They're trying to figure out ways like, oh man, maybe I'll sell stuff on Amazon or maybe I'll do some consulting. Even though I have a full-time job, I really, really want to get into the Solo K, not necessarily to make contributions, because some people make contributions in their work 401k plan, but it's more about, hey, I want to take advantage of the power of the solo 401k exemption from the UBTI tax, which will allow you to leverage up the real estate without tax. So good question, Mike. Next one, actually, Mike's coming through with another one here. Can funds in a Roth IRA be merged into a solo K? So unfortunately, the IRS has not changed the rules yet. There is legislation in the works. What I hear is in the House and the Ways and Means Committee, Secure Act 2.0, which could potentially be passed this year. And I've done a podcast on it on my Adam Talks. And here's just a plug for my 3 podcasts: Adam Talks, Ad Mail, and AdBits. You can check them out anytime or anywhere you get your podcasts: Spotify, Apple, SoundCloud. They drop Tuesday, Wednesday, and Thursday of each week. And I did a podcast on Adam Talks on Secure Act 2.0. And one of the provisions that we expect to pass is they're going to finally allow for Roth IRAs to be moved into Roth 401ks. You can go Roth 401k to Roth 401k, but for some reason you can't go Roth IRA to Roth 401k yet, which again makes 0 sense, which again, Secure Act 2.0 should help. So you could still do a joint venture between the self-directed Roth IRA and the Roth 401k, but it wouldn't be able to be in the same plan. You'd have to kind of have a partnership, joint venture type arrangement where you have the Roth IRA, Roth 401k, commingling the funds to do the investment. So that's certainly possible. Can you move? Okay, we're going back to Bitcoin. Okay, I'll jump into a Bitcoin. Can you move Bitcoin from a traditional IRA at 60 from an IRA to a regular account? Yeah, sure. Once you're over 59.5, if it's a traditional IRA, okay, you're going to be able to move the Bitcoin to your own account. You're going to pay tax on the Bitcoin, the value at age 60, not what you paid for it at age 60. It's just like real estate or cash or stock. You can take a distribution. If you want it to be a tax-free, it needs to go to another IRA. So if you have an IRA with IRA Financial, you bought Bitcoin through Gemini a couple years ago. Now, hopefully you're still up a little bit, even though the Bitcoin market and the crypto market's taken a beating the last couple of weeks, especially today. Man, it's been ugly. You can do it. You can do a tax-free rollover to another IRA if you wish. You can also take a distribution. If it's a Roth, it's tax-free, penalty-free for over 59.5. The Roth's been open at least 5 years. If it's traditional, then just pay tax. So it's actually good timing to do this Ask Adam live, because I feel like real estate's gotten a cold shoulder the last year or so because of cryptos, right? Everyone's been so high in cryptos. And at the end of the day, I'm a big crypto fan. I just still believe the reward far outweighs the risk. But listen, it's not real estate. Real estate, in my estimation, is still the best diversification play. It's a hard asset. It's a good hedge against inflation and get you appreciation, cash flow. It's still, to me, the best alternative asset. So it's kind of good timing, you should say. I never want to see the Bitcoin market drop, but it's a good reminder that, hey, diversification is still important. It's not just diversification from stocks to cryptos, but real estate should play a very important role in your retirement portfolio. It's just something that I feel is super important. How are the UBTI tax calculated through a self-directed IRA? So I will get to that question in a minute. It's a good question. But let me just jump right back to the PowerPoint presentation for the next several minutes. So again, why go self-directed? It's about diversification, investing in assets you know and trust, hard assets, hedge against inflation. I'm a firm believer that if you get to invest in assets that you believe in, you're going to be a better investor, right? Versus sometimes you feel like you got to invest in mutual funds or ETFs and you're just kind of not feeling it. You're not going to pay the attention that you need to do it. And with an asset like real estate, if you feel that you're more comfortable with it, you'll just be more focused and I think a better, hopefully more successful investor as well. So that is the reasons to go self-directed. Again, tax deferral, compounding interest is key, right? That's why the Treasury is one of the 2 reasons Treasury incentivizes people to save through retirement accounts. Number 1 is deductions, right? Before the Roth IRA, all accounts were pre-tax. 2, deferral. Your money grows faster without tax. It's the whole foundation of compounding interest. Every 8 years, your money can double. So as long as you can get an 8% rate of return, power of deferral. Money grows faster without tax, right? Albert Einstein said, compounding interest is the eighth wonder of the world. Not me, Albert Einstein. So definitely way more intelligent than I am. It just makes common sense. And it's why smart people use their retirement funds to invest. And it's why, my IRA is bigger than yours. Like since I've been working, I've maximized my IRA and 401k. And that's why I have a huge retirement account right now. And it's well diversified. It's in real estate, it's in cryptos, it's in stocks. I just feel really good about what I'm doing. And I believe the 28,000 or so clients that use IRA Financial kind of feel the same way. Again, I feel like we should have 100,000, and I give myself like a C-. So there should be lots more people understanding the powers of retirement system, the power of alternative assets, the power of diversification. And that's why I'm doing these types of YouTube live shows, podcasts, why I do 5 videos a week. Just want to educate people like, hey, you should know what your options are. There's a reason the IRS gives all of us the right to do alternative asset investments. They could have disallowed it. When ERISA was created in 1974, they could have said, okay, you can only buy stocks or mutual funds, just like they've done for 529 plans. But no, even the Treasury understands long-term investors, power of deferral, power of diversification is paramount. It is super important, and it's something just people need to focus on. So what can you invest in a retirement account? So let's kind of jump into this real quick, and then I'll get back to some of the questions. So 74, ERISA was created. ERISA, part of ERISA was the establishment of IRAs, and 2 sections were codified to help regulate what IRAs can invest in. That's section 408 and 4975 of the Internal Revenue Code. 408 basically says IRAs cannot buy life insurance. There's an exemption for 401ks, and can't buy collectibles like antiques, rugs, stamps, baseball cards. And then section 4975 talked about various self-dealing or conflict of interest transactions, i.e. buying a house and living in it, renting your house to your children, right? The whole foundation of the prohibited transaction rules is the IRS does not want you to do anything with your retirement account that in some way does not exclusively benefit the IRA or 401k. It doesn't want you to do anything to personally benefit yourself. Why? Because the IRS needs to protect the distribution rules. If investors were able to just kind of gift their IRA money to their kids or their spouse or their parents, there'll be nothing left at age 72 to tax. And the IRS counts on that $32 trillion of retirement money to generate tax revenues, to build schools and highways and help our military. It's part of a very, very large source of tax revenue that the Treasury counts on. So it's very important for them to protect the distribution rules. And if they just let people do whatever they wanted and help their families out with their retirement funds, they would not be able to tap into that tax revenue. So that's why they're so focused on these prohibited transaction rules. But in the real estate world, it's pretty simple, right? You don't have to worry about life insurance. You don't have to worry about collectibles. You basically have to worry about prohibited transactions. And under 4975, in a nutshell, the prohibited transactions basically say this: don't do anything with your IRA that in any way, directly or indirectly, personally benefits you, a lineal descendant, which is deemed a disqualified person, any entities you control, whether it's trusts or entities. You want to make sure, in the cleanest sense, that you're doing retirement investments to benefit your retirement account. So let's take a very simple, clean example. Take your retirement account, you buy a house, right? For $100,000, all IRA cash, and you rent it out to a third party. You get $1,000 a month. That money goes back to your IRA without tax. You have to pay taxes, expenses, and property taxes, I should say, any improvements, expenses, and the net amount stays in your IRA. All right, when you go and sell that property, hopefully those gains and all the cash will flow back to your IRA. Right? Very clean. Clearly not a prohibited transaction. Why? My IRA is the sole owner of the asset. No disqualified people. I'm not renting out to myself, my kids. my spouse, my parents, my daughter-in-law, my son-in-law, super clean, right? Now, on the other side of the spectrum, you have a situation where you have a scenario where the property is $200,000, you have 120,000, and you need 80,000. For some reason, you can't get a loan. What do? Well, you have your own money, so you potentially use your own personal money. What about using your wife's money, personal retirement account, your friend's money, right? So these are the scenarios you need to consider. So let's tackle the first scenario, using your spouse's personal money. Now, we know your spouse is a disqualified person. So if you have a scenario where you're using your IRA money, your spouse's personal money in the same transaction, you could potentially trigger a prohibited transaction. Why? Because now you need to prove that in some way your IRA investment wasn't used to personally benefit yourself. Since your wife also invested, now you've opened the door potentially to an IRS attack, who could potentially say, listen, you've used your IRA to help your wife buy this property. So they can kind of flip the scenario on you and make you have the burden of proof. So my general thought process is as follows. If you are risk averse and don't want any issues, then simply use IRA funds. You can use other IRA assets of disqualified people. So that's the second scenario. Can you use your wife's IRA? Yes, you can do an IRA where your spouse's IRA and your IRA simultaneously invest those funds to buy the property. That is far safer than using your spouse's personal funds, which could trigger the prohibited transaction rules. Now, the safest approach is invest with your friend, right? Any non-disqualified person, or get a non-recourse loan. But you can see how those gray areas play in. Anytime there's some combination of personal and retirement funds in the same real estate investment, you have the potential for an IRS attack. So it's much, much safer and cleaner just to use retirement funds or do a joint venture with a non-disqualified person or get a non-recourse loan. Okay, so the prohibited transaction rules are important, but they don't have to be a problem for you. They're actually not super complex, so long as you keep this simple premise in your mind. You need to be able to prove that 100% of the exclusive benefit being derived by the investment will be derived by your IRA and not you. Okay, and that's it. It's a simple premise. And if you stay along those lines, you will have no issues. Okay, so let me jump back into some of the questions. So I don't want to bore you continuously with these PowerPoint presentations. So I'll get to the UBTI calculation, I promise. If a solo 401k owns single family rental and sells within the first year, will capital gains be deferred profit deposit? So Mike, even better, no tax. When you use a retirement account, this is why, again, I want to keep doing these videos, these live, these podcasts, because it is super important, right? I'm a tax lawyer. I have a master's in tax law. I worked for 9 years at some of the largest law firms in the country. You know, I've written 8 books. Like, this stuff is second nature to me, but it's not so easy. And I gotta keep reminding myself. The beauty of using a retirement account to buy real estate is there's no tax. So Mike, if you put 100 grand into the asset and you sell it for 200 6 months later, and honestly, this stuff's happening. I live in Miami. People are flipping contracts and making wild amounts of money within the first year. Okay, there's no tax. There's no ordinary income tax. There's no capital gains tax. There's no holding periods. There's no basis. There's zero tax. Okay, that's the beauty right there. Whether it's stocks, whether it's real estate, cryptos, any asset that you own in your IRA or 401k and you sell it, there is no tax. Now, assuming there's no leverage on that asset, there is zero tax. So remember that. People still have questions and still consider and think about and even contemplate, say, hey, should I report this on my tax return if I sell this asset in my IRA? No, don't do it. Your IRA owns it, not you. IRAs under Section 408 are treated as tax-exempt trusts. They don't pay tax. That, again, is one of the incentives the IRS is giving all of us to save through an IRA. Deferrals first. Second is the ability to make contributions and get deductions. So it's one of the two factors and two biggest benefits of a retirement account is deferral. So no, you do not have to pay any capital gains. You don't have to pay any ordinary income. Do not put it on your tax return. The money just simply goes back to your retirement account without tax. It's really cool. What is the expected delta between a non-recourse loan versus a person guaranteeing the loan? Okay, personal experience, they're very undesirable, even with 50, 60% down, unless the tenant is credit rated. So I have a bunch of non-recourse lenders that I work with. Actually, the non-recourse loan fund that I was setting up was really geared to helping clients get a bundle of cash they can use on a non-recourse basis. So it's actually not as hard as you think. If you're going to put 30, 40, 50% down, depending on your state and it's income producing, you'll get a loan. I have 3-4 companies, guarantee you'll get a loan. Okay. So Brent, let us know, hit me up. I will put you in touch with these non-recourse lenders. And if you're willing to put 50, 60% down, you'll get the loan. Now, just to add some clarity, a non-recourse loan is a loan you do not personally guarantee. So you cannot get a traditional mortgage with an IRA because Section 4975 states that you can't personally guarantee an obligation of your IRA. So based off that, the loan needs to be non-recourse. So if you're going to put 30 or 40% down, I can get you a loan, a non-recourse loan. Remember, if it's an IRA, we'll have to deal with the application of the UBTI tax, which is basically a net tax on the net taxable income from the asset, which we'll go into some detail in several minutes. But what a lot of people do is they kind of net that payment out, right? So the UBTI tax is only taxed on the net profits associated with the investment. But if you increase your loan payments to eat up all the net profit, you're going to have no tax, because if there's less than $1,000 of net profit associated with the IRA investment, there's no UBTI tax. So that's what a lot of my clients do. They say, you know what, I'll take a 5-6 year loan out. I'll make sure that the loan payments are high enough to eat out all the net profit. Within 5 years, the loan's gone. And then I have a asset that I use my retirement funds to purchase with leverage and didn't have to pay any UBTI tax because I had no net income during the period when the debt was outstanding. So there are some strategies that you can employ to help reduce the application of the UBTI tax, but I will get to it, I promise. If I already have a 401k with work, can I open a solo Roth through LLC consulting company? Yeah, you could. So Mel, you could use, so long as you have side income, you can set up a solo 401k through your consulting business. The only thing that will be limited is your deferrals. So for 2021, the maximum you can put into a 401k is $19,500, $26,000 if you're over 50. So if you're maxing out in your employer's 401k, the 19.5 or the 26, you're only going to be able to put the profit sharing contribution, the 20 or 25% of your consulting income in the solo 401k. That is something you're just going to have to keep in mind. But you can still open the plan. You can still roll funds in through an IRA or a former 401k. Or if you have access to the 401k funds from your current employer, you can roll those funds tax-free into the solo K, make contributions if you can, but of course, use the plan as an investment vehicle to do real estate, Bitcoin, or other investments you want to do. So good question. Yes, you can do that. Any guidance for using your self-directed 401k for down payment and finance? You're prohibited from fixing it up. So Mike, again, good question. This goes back to the whole idea that the cleanest way of doing IRA investments is don't commingle any of your IRA or 401k with either another disqualified person, including yourself. If you need more money, your options, I think, are non-recourse loan or doing a joint venture with a non-disqualified person, a non-parent, non-child, non-spouse, non-daughter-in-law, non-son-in-law, or using retirement funds from such persons. You need to make sure that you have excess money to pay for taxes, improvements, expenses, right? If the property is 100K, you probably want to make sure you got a little bit of wiggle room in there. Now, you can always make contributions to the retirement account to help pay for those additional expenses. If it's an IRA, it's $6,000 or $7,000 if you're over 50, 2021. So, okay, you can go 58 or 64,500. So you do have some room if you are running short on cash flow to pay for expenses, because you can always make current contributions. You just need to make sure that you actually have sufficient income to do so. Can you use your IRA to buy a property and then refi it after the close and escrow and take the money out tax-free because there's a liability to offset the loan? So if your IRA buys the property, the IRA needs to get the loan, right? So if the IRA gets the loan, the refinance goes to the IRA, not you. So that happens. I have a lot of clients that do this. They got to do a deal. They do it in cash because it's a very competitive marketplace. They get the property done. Their IRA gets a non-recourse loan, refinances, dumps more property in the IRA, allows them to go do another deal with that refinanced amount, but they still need to pay that loan amount from IRA assets. Remember, the lender is the bank, but the borrower is the IRA, not you. So the borrower needs to pay back the loan. The borrower needs to have the cash, whether it's in their IRA or through contributions, to pay the loan back. So the refinancing needs to go back to the IRA, and then the IRA can then use those funds for other investments, but the refinancing has to go back, through the IRA. So just remember that, and then remember the application of the UBTI tax, which we'll get to in a sec. Okay, if I use IRA money to purchase investment property, how did the passive loss income with expenses more than income? Well, there's no losses. You don't have to worry about passive activity losses. Again, when you use retirement money to buy real estate, there's no tax. Okay, so if there's no taxes, there's no deductions for losses. So that's the downside. Probably the downside of buying real estate with a retirement account is this. There's no losses, there's no deductions. The tax advantages are clear, right? Deferral, compounding returns, tax-free returns in the case of a Roth. Those are the clear advantages. The disadvantages is if you buy a property for $120K and sell it for $100, that $20,000 loss is not deductible on your return. You don't own the property. Your retirement account does. Retirement accounts are not taxpayers. They don't file 1040s. So they don't get the ability to take that loss deduction. So that's probably the biggest disadvantage of using a retirement account to buy real estate is you don't get losses, you don't get deductions that flow on your tax return. So the passive activity losses, the at-risk rules that are section 465, 469 don't apply to retirement accounts because they're not taxpayers. Next question. We are buying low-income tax credit properties with self-directed IRAs, no debt, but a bond is required for the tax credit investors, and they're asking us to personally guarantee. Prohibited? I would not personally guarantee any loan obligation. So if they're asking you, it's not debt. I'm not sure, bond. You may want to call me on this, Darren, so I can learn more and get more details. I'm not sure what this bond actually is, because the personal benefit, personal guarantee, generally under 4975 is tied into a loan. So I'd have to look at the bond and the language to kind of understand potentially what ramifications there would be if there is a personal guarantee. But generally, I would try to stay clear of any personal guarantee when it comes to retirement assets, because violating 4975 could trigger the prohibited transaction rule. So I would kind of stay away from that. So just wanted to jump in real quick, going back to the presentation. 3 keys to buying real estate with an IRA or 401k. The first is do your research, right? You got to consider all the costs, the expenses, the closing costs, improvements, repair, taxes. Do your research. Know what you're buying. Whether you're doing the research online, you're driving around your neighborhood, know the asset. Some of the biggest issues I've had clients experience with real estate is when they're buying real estate in foreign countries or in states that they're not familiar with through third parties and they haven't done their research. and they realize that, oh no, I just bought real estate in a really bad area, or this asset doesn't show as well as it should, and maybe I overpaid. Online, there's amazing sources. It's much easier today than 15 years ago to buy real estate online. Do your diligence, ask questions, go on Google Maps, Google Views. You can look at the property, go to Zillow, Trulia. You can get a really good estimate of what these assets are worth. Number two, again, consider the IRS prohibited transaction rules. If you're doing something on your own, just you and your IRA is going to own 100% of the asset. You got no prohibited transaction worries, right? Don't do any of the improvements yourself. Don't do the fix-ups. Don't do any of the plumbing, the fixing the roof, the landscaping. Hire third parties to do it. You should not provide any services to your IRA assets. That's under Internal Revenue Code section 4975, and it's pretty clear. So you want to be very, very certain that you're not providing any active services. Now, there are exemptions under Treasury Regulation section 149.75-6 that say you're allowed to do what's reasonable and necessary with respect to your IRA. So, of course, you can hire an accountant, a lawyer. You can do the setup, right? There's certain things. You can pick the property. You can decide the price. You can decide what to sell, just like you can decide what stock to buy, what stock to sell, what broker to use. I mean, you have basic rights and basic powers from a reasonable and necessary standpoint to provide services to your retirement account. You just be cautious of not doing anything that's not reasonable and necessary, like mowing the lawn, like painting the walls. You can certainly get a third party to do it, but you can pick the property. You can decide who rents it. You can decide the price. You can decide what color the sofa is, or what color the roof is. You just can't do the work yourself. So again, I always try to say you can sit back in your chair, on your chair, at your desk, and think about what you want to invest in, how you want the investment to look like, what the economics are, and you can then pick up a phone or shoot an email off to a third party to actually get that work done, whether it's the marketing, whether it's the improvements, the services, things like that. That is, I think, the proper way of approaching a self-directed investment, is to be hands-off. Less is always better. Push off anything you can that's not reasonable and necessary. And if you do that, you're going to stay away from any prohibited transaction rules. If you are potentially doing a transaction with a lineal descendant on the other side, be cautious. You're opening that window just a bit, depending on how much activity you're doing or the facts and circumstances. The window could be ajar a little bit or significantly more, again, depending on the facts and circumstances. If there's an investment fund of 50 investors and your IRA is going to own 8% and you personally is going to own 3%, probably okay, right? 49.75 is clear. 50% threshold for disqualified entities. However, there's case law and 49.75 C1D, E, and F, which are more of the catch-all provisions, which can come in and potentially turn an investment that looks on its face to be okay because there's under that 50% threshold to potentially be prohibited. And I always give this example, and I'll give it again. If you've heard this example, you can tune me out. But for all the new viewers out there, Rollins v. Commissioner, it's a 2004 tax court case. This guy Rollins owned less than 50% of a bunch of entities. He was an accountant. And the facts are the companies needed money. So he took his 401k and lent the companies money. Again, he owned less than 50%. He was not even an employee of the business. He was simply an investor. And I think he sat on the board of one or two, but he's not an employee. And the IRS said they figured out there was a prohibited transaction, not sure how. And they went to tax court, and the tax court agreed with the IRS. And they basically said Rollins could not prove that the use of his 401k as a loan did not personally benefit himself. Again, it goes back to that premise. You need to be able to prove exclusively 100% that the benefit being derived by the investment is that of the IRA or 401k. In this case, the facts were such that the companies needed money. And Rollins can prove that that loan from the 401k did not in any way personally benefit himself. If he could show that maybe there were 30 other investors willing to give him the money, that could have been a better fact. And maybe the IRS or the tax court would have considered that in their conclusion. But based off the facts presented, the companies needed money. And he took the money from his 401k, lent the money to these companies. And even though he was under that 50% threshold, he still triggered the prohibited transaction rules and blew up his transaction. So again, anytime there's a disqualified person, in this case was Rollins entities that he owned less than 50% of personally, and on the other side it was Rollins' 401k, they got in the same deal, risk reward. In this case, you would think the window would be open just a little bit, but the tax court thought it was open too far, and they jumped in and argued prohibited transaction and won. So be cautious. Okay, that's number 2. And then 3, UBTI, unrelated business taxable income, which I want to spend time on right now. So the unrelated business taxable income is a 4-letter word for real estate investors. It's a hidden tax trap that generally applies when an IRA uses a non-recourse loan to buy real estate. It could also apply in the IRA setting or the 401k setting when a retirement account invests in an active trade or business, like a restaurant or a consulting company, that's operated through a pass-through entity like an LLC. So if you invest in Tesla or Apple or Google, those are corporations. So think of a corp as a big box. The income's boxed in, and any net income, retained earnings, will be dividend up to the shareholders. And there are 2 layers of tax. So if you own a corporation or invest in a corporation with an IRA or 401k, there is no UBTI tax because the corporation pays its own tax. However, if the IRA or 401k invests in a pass-through entity like an LLC, and that pass-through entity is a business like a bar or a restaurant or a manufacturing company, and there's net income above $1,000, all the income allocated to the IRA or 401k would be subject to this UBTI tax, which follows the trust tax rates and could be a tax as high as 37% on income approximately over $20,000. So just be cautious. Now, going back to real estate and leverage. Remember I said there's an exemption under 514c9 if you use a non-recourse loan to buy real estate with a 401k plan. That exemption does not apply to IRAs. Now, I've been working, I'm friendly with a couple congressmen in the Ways and Means Commission and and I've been pushing them to kind of consider adding IRAs to that exemption under 514c9. Hopefully I get somewhere. If you do know a congressman, talk to him or her. It makes no sense, right? The UBTI rules, actually the whole application of the UBTI rules makes 0 sense to retirement accounts. Why? The unrelated business taxable income, if you look at its legislative history, its background, it was put in the code really to stop for-profit companies like McDonald's from setting up charities and running their business for charities and never paying tax. Okay, and unfortunately IRAs and 401ks are considered 501 trusts. So they got grouped in with charities like the Red Cross, even though they're not really a charity, right? The Red Cross has an exempt purpose. IRAs do not have any exempt purpose. Anything they do from an investment standpoint is not part of their exempt purpose because they're not created to have an exempt purpose. Their only creation is to accumulate wealth. Unlike a hospital or a charity that's focused on feeding the poor, it has an exempt purpose. So a hospital has a gift shop. That income from the gift shop is not part of its exempt purpose and actually would trigger the UBTI tax. That's why a lot of charities will just outsource and rent out their gift shops to a third party and just collect rent, which would be exempt from the UBTI tax. Capital gains, interest, dividends, royalties, rental income, passive categories of income are exempt from the UBTI tax. Going back to real estate, it's only going to get triggered, the UBTI sense, in a self-directed IRA if you use leverage on a non-recourse basis and the net profits are above $1,000 at the end of the year, or if you invest in an active real estate business, like a development company. Otherwise, you're not going to have UBIT. And in the solo 401k, there's an exemption if you use leverage, non-recourse loan. But if you invest your 401k in an active real estate business, you're still going to get hit with the UBTI tax. So UBTI tax is an ugly four-letter word. It could turn a very tax-friendly investment into a tax nightmare. I honestly found out about UBTI kind of as I was starting this company about 10 years ago. I got stuck investing in an IRA into a master limited partnership for oil and gas, got some bad advice, and turned out that these MLPs actually trigger UBIT. And I had no idea. And then suddenly I got a call from an accountant at a big accounting firm saying, hey, I'm filing your 990T for your IRA and I have some questions. I was like, what are you talking about? What the hell is UBTI? And that's how I kind of learned as I was starting this company that some investments that get this UBTI tax imposed on them really become a problem. So you need to understand these rules. It's so important. And that's something that when I started IRA Financial, I really wanted to focus on education. That's why I wrote 8 books. That's why, again, I do these things. I want people to understand how to do investments properly and tax efficiently. There are ways to potentially get around UBTI. I can't tell you how many times I get emails from people saying, oh, Adam, I wish I found you 3 years earlier. I set up a self-directed IRA with someone else. I did crowdfunding or I did this real estate deal. And now I realize I owe UBTI tax. The 3-year statute hasn't run. I'm worried about getting audited. My account wants me to go back and file 990Ts. And if I knew about it, I may have been able to do something else. Maybe I would have done personal funds. I had a 401k. I could have used the solo 401k to do that deal. So I really believe that's what separates IRA Financial. Yeah, our technology is great. It's really our expertise. It's our passion. We're IRA people. We don't sell investments. We want to make sure that we admin and custody your IRA and give you all the knowledge you need to be the most tax efficient investor you can be. So those are the 3 things. Again, do your diligence on your deal, beware of the prohibited transaction rules, and understand the application of UBTI. Those are the 3 most important things to take away from this presentation. The other things are self-directed IRA versus solo 401k. Okay, this is another important area that I was hoping I'd get a question on. That's why I didn't touch upon it when I started the presentation, but let me just jump into it now. You're thinking of doing an alternative asset investment. You find me on YouTube or Facebook or Instagram, or you check out IRA Financial. You're like, oh, this kid knows what he's talking about. Or I still think I'm a kid, even though I'm going a little bit gray and I'm getting up in my 40s. I'm still a kid. And you say, hey, I like this guy. I want to do it. First question is, what do? You have 2 options, right? You can do a self-directed IRA. We actually have 3 options. Self-directed IRA, self-directed IRA LLC, and a solo 401k. How do I make up my mind? So the first thing I would say is, are you self-employed? If you're self-employed and have a business with no full-time employees, other than yourself or a business owner or spouses of those owners, you can't have more than one spouse. Maybe you could somewhere. Solo, okay, go solo. Why? You can do the same investments as an IRA. You get the leverage exemption for UBTI. There's a loan feature of $50,000. Super easy, great creditor and asset protection. You get an IRS opinion letter. You can be the trustee. You can do stocks. You can do alternative assets. High contributions, 58 to 64,000. If you're over 50, 500. So you can't lose. This IRA is not going to give you anything the solo can. So that's the first thing. I'd go solo right there. But you're not self-employed. So now your choices are, okay, I got to do self-directed IRA or the self-directed IRA LLC. What do you do? So they're both great platforms. Before 1996, everyone basically just did a regular self-directed IRA, which means that you open an account with IRA Financial or another regulated trust company. You move the money over as tax-free. We then facilitate that investment for you, whether it's real estate or private equity or Bitcoin. The investment's made in the name of the IRA. So IRA Financial Trust Company for the benefit of the Adam Bergman IRA. And then we do all the IRS reporting. Okay, we pay any taxes, 5498. When I say taxes, I mean property taxes, no income taxes, right? Again, no taxes when you do this stuff. That's the value of using a retirement account to make investments. And the investment title and the name of the self-directed IRA, you need to go through the custodian to take distributions, make contributions, and pay any investment-related expenses. 1996 came along, Swanson v. Commissioners, the first tax court case that said, hey, your IRA could wholly own an entity and you can manage it, and that will not trigger the prohibited transaction rules. And since Swanson, there's been a bunch of IRS rulings, various case law. So over the last 25 years, the self-directed IRA LLC, also known as the checkbook control, has become the most popular way for real estate investors to buy real estate in their IRA. Why? Limited liability protection, number one. The LLC protects your assets outside of the LLC from creditor attack. Number two, more privacy, right? Titling of that asset is not in the name of the IRA, it's in XYZ LLC. Generally form that LLC in the state where the real estate is located. Also in terms of speed, because you have the LLC is opened at a local bank. We have a relationship with Capital One where we can open that bank account for you. And then you write the checks, you do the wires or the ACHs. You don't need to go back to IRA Financial to pay a plumber or to pay the property taxes or to get a real estate transaction done. You as the manager of the LLC can do the closing, sign the docs on behalf of the LLC, get your deal done. So it's very attractive to real estate investors. This is what I would consider. If you're doing a lot of frequency of investments, flipping, you're going to need a checkbook or access to wires, LLC makes sense. If you're worried about limited liability protection, LLC makes sense. If you're worried about privacy, you don't want anyone to know you own this asset, LLC makes sense. If you're doing one-off stuff like private equity, hedge funds, or even land, you may not need the LLC. If you're doing Bitcoin through Gemini and our platform, which again is the best one out there, you control the keys, you control the trading through Gemini. You don't really need an LLC because you can actually open the account in the name of the IRA that you control, and we will take care of all IRS reporting. So that would be kind of my guidelines is self-employed, go solo. If you are not self-employed, then you have the IRA versus the LLC. If you want control, you want limited liability protection and privacy, go with the LLC. If you don't, and it's one-off investments, you don't need the LLC. So that's important because you want to make sure you're in the right product. Once you're in the right product, then you can, I think more tax efficiently make the investments. If it's real estate, leverage, solo K is probably a better option. If it's not, then you want to consider using the LLC or not. So let me jump into a few more questions before I tackle partnering with your IRA again. Team IRA Financial is top notch. Thank you. We try our best. We work really hard. COVID has been a challenge. We've seen 400% in growth. We've hired over 30 people this year. There has been some growing pains. I'm sorry. We're trying hard, but we can do better. There's been some delays in getting transactions done. So we are on it. I promise we're going to get better. Our technology is improving. But thank you for the kind words. I really appreciate it. How can I get a loan as the amount I have in my self-directed IRA is not sufficient to buy an investment property? Well, again, you're generally going to need 35%. If you can't get it done, there's other things you can do. There's partnerships we're working on with REITs, fractional real estate, where you can get in for as little as $100 in a real estate property. That's kind of the stuff we're looking to launch in the coming months, where we're going to offer our clients the ability to get access to certain deals that only they can get access in for as low as $100, where you don't need to have $100,000, $200,000 to get property purchased in your retirement account. If you want to wholly own that property and you don't have enough, do a joint venture with friends, colleagues, even family members. Just make sure they only use retirement money and don't use personal funds as well, because you don't want to trigger those prohibited transaction rules. What is the best way to transfer property from a self-directed IRA to personal property? Well, if you want to take a distribution, yeah, you're going to get that property distributed. I would try to make sure it's at least 59.5, right? Because if you pull that property out prematurely, before 59.5, you're going to pay tax and a 10% penalty on that property value. So try to wait as long as you can. You basically need to get that value property. We'll file a 1099-R with the IRS and then quick claim it to yourself. If you own the property in the name of the LLC, you can just flip the operating agreement, amend it where you own it personally. We'll file a 1099-R, and at that point, you own the property and just pay tax on your 1040. Basically, the amount that you've taken as a distribution is added to any other income you've earned during that year, and based off your adjusted gross income, you're going to pay tax. A little off subject. Can you buy shares of a foreign company with a self-directed IRA? Yeah. Again, as long as it's not life insurance, collectibles, or self-dealing conflict of interest transactions, you can do it. Whether it's foreign real estate, foreign businesses, cryptos, gold, you can do it. Can you have a clear instruction for register the account with Gemini through the self-directed IRA? I have trouble setting it up. They didn't have the customer service. Yeah, that's why you need to go through us. If you go through Gemini, it's going to take you weeks, if not months, to open the account. If you onboard to our app, set up an account through our app, an IRA account, you move the money to IRA Financial, we will then send you a link from Gemini that you will be able to open your account, fill out a couple questions in minutes, submit that application. Within days, we will connect and link your Gemini and your IRA Financial account together, move the money from us to Gemini, and within days, you're trading. You never have to pick up the phone and talk to Gemini. You never have to chat with them. You can chat with us, and we will be able to link your accounts and get you onboarded onto Gemini, custodied in the name of the IRA, where you can trade cryptos, and best of all, you control the keys, right? I was at the Bitcoin conference a few weeks ago. I heard Jack Dorsey say, no keys, no cheese. And it's true. Okay, you want to be able to control your keys, or at least have that option. And we're the only company in the country that will let you use an IRA to buy cryptos without a broker, without paying excessive commissions. Can't even say that word because it drives me crazy when I hear people paying 2, 3, 5% commissions to some companies for nothing. And you don't even need an LLC. You can control the cryptos, and then we could pull it off the exchange for you, give you the ability to do so, and then you can hold it in a hot wallet, cold wallet, hard wallet, whatever you want. Use a DEX, decentralized exchange, to then trade it, whether it's Uniswap, SushiSwap, and you have total control. So I don't want to jump off topic. I know this is kind of a real estate focused Ask Adam, but hey, if you send me the question, I'll answer it. When I take money out of my IRA, when I need to use it as ordinary tax. Yeah, when you pull money out of your IRA, if it's a pre-tax IRA, it's subject to ordinary tax. So under 59.5, tax and 10% penalty. Over 59.5, tax. If it's in a Roth IRA, so long as you're over the age of 59.5 and the Roth's been open at least 5 years, there is no tax, right? So something to consider. Last thing I want to talk about, and again, I briefly talked about this, but I just wanted to speak on this subject again, because I get a lot of questions about this. And unfortunately, there's no right or wrong answer. It's based off facts and circumstances. But I wanted to kind of go through this in some details. So can I partner with my retirement account for real estate? So the facts are, you want to buy real estate and need some personal funds, and you want to commingle with your retirement accounts. So as I mentioned, it's all about facts and circumstances. So you got to be cautious. Anytime that you use IRA and personal funds in the same transaction, right? It's about that window. How ajar, how open do you want that window to be so the IRS can stick their hand in there and potentially ask questions? One side, cleanest, no disqualified person other than your IRA and the property. It's the cleanest. Your IRA owns 100% of the asset. All the income and gains flow back to your IRA. Other side, you don't have enough money and you need to do a joint venture. What do you do, right? So you can joint venture with third parties, non-disqualified person, non-parents, non-child, non-spouse, non-daughter-in-law, non-son-in-law, non-entities or trusts you control. Okay, that's fine. Neighbors, friends, no problem. Brothers and sisters are not disqualified people, by the way. Siblings are good. If that doesn't work because they don't have enough cash or they just don't want to do a deal with you, then you can look to do deals with disqualified persons, so parents, children, spouse, daughter-in-law, son-in-law, and their retirement accounts, not their personal funds, and their retirement accounts. So that's another option. Okay, thirdly, non-recourse loan. But remember, it's a non-recourse loan, and you're going to have to pay that loan back and potentially deal with UBTI. So it's all about facts and circumstances. The last thing I want to mention is this case called In re Kellerman. Okay, and this is a bankruptcy court case from 2015. And basically, in this case, this Kellerman's, they had a partnership between their IRA and an entity they owned themselves personally. Okay, this guy Barry Kellerman and his wife each owned 50% interest in a Panther Mountain personally, this partnership. Okay, and to do a deal in this 4-acre property, the IRA and this Panther Mountain entity formed a partnership where the IRA contributed the property and Panther Mountain put the cash in. Okay, so you have a deal where you have IRAs and you have an entity owned by the Kellermans. And they do this joint deal where they combine assets and cash. And unfortunately, the court rules that it's a prohibited transaction, right? They basically said that Kellerman couldn't prove that the use of his retirement fund didn't help himself personally, right? What happened here? He had an entity that him and his wife owned personally, cash and property, and then took IRA assets and combined it. And it opened the door or opened the window for the IRS to stick their hand in there and say, hey, Kellerman, prove, because again, the burden of proof is always on the taxpayer. Prove to me that you didn't personally benefit from this deal. And it's harder, right? Because now you have your personal assets in this deal. So it's harder to show that, hey, yeah, my IRA fund didn't help because, hey, if you didn't have the capacity to do this personally, what argument do you have? Now, if you're Warren Buffett or Jeff Bezos, you could be like, yeah, I have $40 billion. Like, I could have done this personally. I wanted my IRA to participate because it's a good deal for my IRA. That's a good fact. If that was in the Kellerman case or the Rollins case, I think they would have been successful. However, if you need the money and your only alternative source of funding is the IRA, and you do a deal where you're commingling the funds, you could potentially run into a wall, and you could potentially run into the long arm of the IRS. So when it goes to facts and circumstances, that's what I'm talking about. That's what we provide at IRA Financial, a sounding board. We will help you navigate these rules. We want to educate you. There's not always a right or wrong answer. Whether you're talking to us, another company, or so on and so forth, there's sometimes not a right answer. But it's important to understand your risks, and it's important to understand the case law so you can potentially best structure a transaction that will not run afoul to the IRS rules and also remains tax efficient. So the Kellerman case is a good example because I get these questions all the time. Hey, I got $130,000 in my IRA. I got $80,000 personally. I want to buy this property of $200,000. Can I do it? So, well, technically, yes, but this is what you need to consider. Do you have the capacity to do this personally? Do you have $1 million personally to do this? If you say yes, say, okay, I like that. If you're like, no, I really need my IRA money to get this deal done, not a good fact. Why? Because the IRS is clear. Rollins, Kellerman, they're clear. When your IRA makes an investment in 401k, it needs to be done to exclusively benefit the IRA. That means 100%. There can be no 1%, 2% benefit derived by the IRA owner. So if you say, Adam, nah, I really don't have enough money, like I need my IRA money to do it, not a good fact. Because the IRS could make the argument that you've done the IRA investment not to help your IRA, but to help you personally. No bueno, no good. So that's the line of reasoning you need to consider when you are doing investments with disqualified people. If there's no disqualified people at the other side of the investment, you got nothing to worry about. It's super safe, super clean. It's a great way to diversify, great way to take control, great way to generate tax-deferred or tax-free income and appreciation on your assets. But you need to be careful, okay? So that's kind of the last thing I wanted to mention. Here's what the internet says, be careful, right? There's lots of stuff out there that says, yeah, you can do this, you can do that. I've heard people say you can do all kinds of crazy prohibited transaction things. Be careful. Look, read who's saying what they're saying. If they're not an attorney and they're not regulated, be careful. Okay? Ask them. If it's a person, check their credentials. Are they an attorney? Are they a CPA? Who are they? If it's a company, make sure they're a member of RITA, the Retirement Industry Trust Association. I'd be cautious and careful not trusting custodians or companies that are not members of RITA. Just simple as that. If they're not interested in taking the time and spending the funds needed to be a member of RITA, be careful. Okay? And otherwise, read, educate yourself, do your diligence, and just remember 3 things. Pick the right product, whether it's IRA or 401k, do your diligence on your investment, and beware of the prohibited / unrelated business taxable income rules. If you do that, you're going to have no worries, no concerns. This is not something that has to be scary or risky. I can't tell you how many brokers, including some friends of mine, that are always saying, Adam, I don't want my clients doing alternative assets. It's so risky. It's so scary. And I'm like, yeah, right. It's risky and scary because you don't want them to pull money away from you to buy real estate. Let's be honest. It always comes down to money. It always comes down to compensation. Real estate is not scary. It's a hard asset. I think it's much safer and less scary than buying stocks or mutual funds that go up or down for no rhyme and reason. I like to sleep at night knowing I have a hard asset. I have a renter. I get cash flow every month. I don't have to worry about all this other stuff. That's important to me. And it's obviously important to millions of other Americans. And if you are someone who's interested in real estate, you should know the IRS gives you the power to use your IRA or 401k to buy real estate or do other real estate related investments in your retirement account. I'm not telling you to do it. It's your money, but you should know your rights. And I'm here to hopefully educate you of what your rights are, how to go about best doing so, what are the IRS rules, and how you can do so in the safest and most tax efficient manner. So I just want to thank everyone for watching. Subscribe to my YouTube channel if you haven't already at IRA Financial. 5 posts a week, 3 videos, 3 podcasts, sometimes more videos. If I get going, I feel that extra urge. Anything that's timely, I will post a video or podcast on. New retirement legislation, any new legislation involving taxation, retirement accounts, alternative assets. I'm your guy. So there you go. I really appreciate you listening, watching. Thank you for being part of the Self-Directed Retirement Nation. If you want to be part of the Self-Directed Retirement Nation, let us know. We'd love to work with you and help you take care and take control of your retirement future. Be well, be strong, and talk to everyone again soon. Thank you for listening and watching.